Good morning, everybody. This is Dennis Wilburn with the Active Trend Traders. Joining me you're in Zurich, right, Michael?
I am, yeah.
I always ask that question because I get confused between Zurich and Munich. But I know there's two totally different places. No, but Michael's from Zurich. Mike Traeger will not be with us today. He had an unexpected, uh, small emergency that he needed to get to. But I want to welcome everybody here, and let's get going. All materials that we do present are for training purposes only, and traders are always encouraged to paper trade any new method prior to the risk of their own personal capital. Here's a disclaimer on Michael. So it's similar, but this is the European disclaimer. So we have been having a series of training sessions on Tuesday nights. The next training session is for the premium members of the Active Trend Trading system. February 2nd, where we're going to talk about understanding short setups. Because while the market looks really, really good and really, really strong today, when we get to the charts, we may be looking at some of the, is it really time to get long in a big way? And I'm going to let Michael also, and Michael's going to chat about that briefly, but understanding short setups and what they look like is what we'll be covering on Tuesday night. Last Tuesday night, we covered the leverage tons of them, some things to look out for, especially with the inverse index index ETFs, and got some really good comments back on what we explained during that session. And I hope if you haven't seen it, and if you're a premium member or an early warning alert member, you can go to the website and catch the recording. So this week, well, last week we were saying start of a new uptrend, or is it a dead cat bounce? And then immediately we run into the week of the Fed meeting. And when we look at the charts in a little bit, we'll see how the basically the price action just kind of stalled out for the first 4 days of the week, and we're getting a little bit of a rebound today as the market does climb higher. So we are in the process of, most of this week has been spent posturing for the Fed. And then the market took off today, and it was a situation where bad news was good news. But we've had both good and bad earnings report. Just take a look at Amazon and take a look at Facebook. Take a look at Netflix. Google reports on Monday after the market closes. And so we'll see if the FANG stocks are going to be well, 2 out of 3 of them so far have disappointed. Facebook did make a really strong showing, makes Facebook a prime stock to get onto a potential long list from what I'm seeing. And now we're just waiting for a pullback to be able to do that. S&P, it is moving up towards resistance. The question is, will it stall when it gets up to the strong resistance level? And where is the strong resistance level? NASDAQ 100, who will lead? Which is a good question for the NASDAQ 100, because we saw Apple disappointed. Facebook didn't. Amazon disappointed. Google reports next week. Netflix has not been doing all that healthy. So who is going to lead, which stock will lead the NASDAQ 100 back into a strong position? And, right now we're waiting for that leader to emerge. I mean, is it Facebook, and can Facebook do it all by itself? Then the Russell, will a slower pace of rate hikes actually help the Russell? In other words, on the news that came out this morning, the U.S. economy, the GDP grew at a measly 0.7%. They were expecting 0.9, and even 0.9 in a healthy, robust economy would be a bad number. So That's one of the questions that has to be asked on the influences from the outside. But that was interpreted as, okay, that's good. The Fed will now delay the March potential rate hike and maybe push it out to September. So that may benefit the Russell, which is a little bit more sensitive to rate hikes. And we have to remember that Russell has been beaten down and is still in a bear market. Outside influences for the week, of course, oil is an ongoing influence. Big questions on China, U.S. economy, slow growth. And then the big surprise that also seemed to catapult the market today was the Bank of Japan going to negative interest rate on their for their bigger clients. You know, but still the question is, has anything really changed? Or are we just in the process of getting a good relief bounce? You know, or a dead cat bounce, if you will. And so bad news is good news. It's being interpreted that way. And we can still look forward to a reversion to the moving averages on the weekly charts. Now, Michael, you were saying something about an issue with bonds, in that bonds are
Yeah, I mean, in the last, I think that's really a good, or at least when I start the day, I look at the spider, I look at TBT, that's TLT, sorry, that's the 30 years treasuries, the Nasdaq, and the Russell, plus oil, and the volatility index. Then you have a little bit picture, and in the last, the relationships have been quite stable. So basically, if stocks go down, bonds go up, and the other way around. And I know some traders who used when the bonds are going, because the bonds seem to be the weakest. I mean, if we had a very strong down move in stocks, so bonds should have gone up significantly, and
right.
They have not really, and so you have an inverse correlation, and that was pretty stable in the last 4-5 weeks. And today I was surprised that TLT is going up 1.5%.
Yeah.
So they are correlated.
So
and I mean that's a negative, or maybe a very pessimistic interpretation, but it could also mean if the spider goes down in the next who knows, next days or weeks, then the treasuries go down too.
So that's good, right? Or that's bad?
No, I think it's bad for all bondholder.
Okay. So, well, one of the other thing that, you know, a lot of the reading I'm doing is many of the larger portfolio managers and that type of stuff are all still talking about they don't think the downside is over, and what they're using. And we'll see as we get closer to the end of the day today, see if we get any indications there, but also looking on the weekly charts. They're using any type of upside opportunity. In other words, when the market moves up in a little bit of a relief rally, they're using that as an opportunity to lighten their exposures to equities, to stocks, which is, you know, that's basically the typical kind of action that one would take during that the professional money managers take when, you know, their anticipation is, hey, there's more downside to come, and we don't want to, you know, have the risk of exposure. You made a comment earlier, Michael, about this is a high risk market. And partly I think that is primarily due to one, all the unknowns. The world economy is definitely not as robust, and is in fact slowing down. We see that in the case of China, and the equilibrium point has just not been reached from which the market can make a sustained move higher. I mean, we may get these bounces 2 or 3 days up, 4 days up, and then a reversal back down for 2 or 3, 4 days down. And so we may get stuck in the quagmire of a range-bound market, or it may get even more serious than that, especially if we get bad news out of anywhere in the world, to drive the markets down into a more deeper correction, and maybe drive the S&P and the NASDAQ down towards a bear market. We shall see. So the percentage of stocks above 20-day moving average, this was last week. We had just basically bounced off down here in the low single-digit area, bounced up to the 15.4 level. This week we show that it's kind of interesting is these stall days after, in waiting for the Fed, but there is a little bit of a slightly positive bias as the prices have pushed up today, and the indicator of the percentage of stock on the NYSE above the 20-day moving average has moved back up above the 40 level. So 40% of the stocks on the NYSE are above their 20-day moving average. Countering this, though, are the number of stocks on the NYSE. This is a weekly chart rather than a monthly chart, that are above their 200-day moving average. And so what this is telling us is that on many stocks out there in the NYSE, the 20-day moving average is actually below the 200-day moving average, which is in reality a negative, meaning that there's a lot of stocks out there that are in very significant correction. A large percentage of the stocks, even on the NASDAQ and the S&P and the Dow, are actually already in a bear market type correction, but they're being held up by just a few of the stellar leaders. And as we see, last week we were at 18.2. We made a little bit of a bounce up to 21%. That the number of stocks above their 200-day moving average has moved up to 20%, but that's still approaching 80% of the stocks being below the level below their 200-day moving average. And by definition, I think Mike Traeger covered this on Tuesday night, or maybe it was last Friday, that in some people define a bear market when more than 50% of the stocks in a particular index are below their 200-day moving average. If it's greater than 50%, that means it's more prone or is in a bear market. And so kind of an interesting thing. What we are anticipating here is we may get some just chewing back and forth like we saw over here back in 2011. And then once we got this consolidation out of the way, towards the end of 2011, then we got a really nice rebound, which is a really healthy tradable rally when it popped back up and ran up really hard during the first time of 2012. So we'll see what the rest of 2016, see what kind of a pattern this puts in here, and so we may be setting up for more downside, but the further down we go, once the rebound does happen, the healthy, it will be a more healthy rebound if it's starting from a much lower level. So here's where we sit. A little bit of a bounce up from last week, as we've seen with the relief rally. The Dow is up about, not quite 2%. From where it ended where it was last week at 9 o'clock in the morning. Same thing for the S&P, up about a percentage point from where it was, or down up about a percentage point from where it was last week. Same thing with the NASDAQ. and the Russell. As you can see, the Russell still insist on being kind of the slow mover. The Russell has still maintained, and this is from the highs of 2015, is sitting down at 21.15%. It is the weakest link currently. So let's look at some charts here. There we go. So here's the S&P, and as we see here on the daily chart on the left-hand side, we see that the price action went into kind of a bit of a consolidation, doing nothing, almost like a stalling technique. At the same time, there was not a good trigger. Here's Wednesday when the Fed reported, sold off, but held at this support level. But there was not a good reversal candle in that consolidation to go for a long trade. Now that we have a nice bounce above the 8-day moving average, any retreat to the 8-day moving average is starting to trend up. Any retreat to the 8-day moving average would potentially trigger a trade on the index ETF for the S&P, which is SPY, or UPRO, which is the 3-time leverage index ETF. And so where is S&P going? S&P is pushed up into the fib box, which is basically the 38.2 and the 61.8% retracement that was measured from this high here to this low here. And according to Dow theory, this is where we would expect prices to start stalling out, because it's typical on a run like this from high to low for it to retrace at least back up into the 1/3 to 2/3 level. I've highlighted here the 1950 level, which actually corresponds to, previous levels of resistance where price action pushed up against and then dropped. And so that is slightly above the 50% retracement level, and that's an area of interest that I'll be watching as prices look like they move up. We never got to consolidation down in this area or move back down in this area for a potential long side trade. And so now that we have got to bounce back up, I'll be looking for the bounces off the 8-day moving average. Over to the weekly chart, it appears as if weekly momentum. Over here on the weekly chart, we have an uptick in momentum. That could be good. And we also have the true strength indicator starting to turn up after this has made a new low. This would constitute a positive divergence. And so we'll see what transpires with the index going forward and how it relates to both the index ETF and the straight index ETF, both non-leveraged and leveraged. Joe asked on S&P, isn't there a spinning top yesterday indicating a reversal? And the answer to that is yes, there is a spinning top. However, it is not a spinning top at the end of an uptrend or a downtrend. So basically what it was telling us at this place, it was in a place of indecision, because spinning tops and dojis are more not a reversal signal as much as they just show indecisions between buyers and sellers, and they can lead to a potential reversal. But right now it was just showing us it was a consolidation area. So let's see here, and I'll point out one other thing is as we see this push up, as you can see, the price, the true strength indicator on the daily has not pushed back up to the 0 line. So oftentimes, if this is going to continue into as a downtrend, what will oftentimes happen, it'll push up a little higher, or even, who knows, the 20-day moving average may be the line in the sand that price action doesn't push through. And the true strength indicator will get closer here to the 0 line. The momentum will get closer to the 0 line, but then if we reverse back down, This also can rebound down and come back here and test back along the 50 as it did here, as it did kind of here. It can Pinocchio its nose up a little bit above it a little bit, but then it went on to drop from there. So let's take a look at the NASDAQ. There we go. Here's the NASDAQ, and let me get some of this. I thought I had cleared these. There we go. As we can see, we have basically a move up. This is a good indication. NASDAQ actually showing a little bit, I'd say more positive, but in a weak kind of way. That's the other thing. The actual volume on today's move so far is below average so far. So this may just be a little wedge up under low volume, gets up into a resistance area, stalls, and then rolls over. We'll see if that takes place. But it is currently continuing on with its relief rally. It is short of the 38.2% retracement, but it is above the 8-day. Can actually kind of say the same thing about this. Any type of retest back here into the 8-day, towards the 8-day, might be a setup for a trade to the upside, but it may have limited legs in that it starts running into resistance fairly quickly. Same thing here. Here's the 8-week moving average, and this is the same way on every one of the indexes. That's where, as it continues to fall, that's where we would anticipate some stalling when those match. As we can see, the NASDAQ is not moving up as rapidly as the S&P, not with as much energy and momentum as the S&P. It's staying below these highs over here. And so it may be showing that, and again, it gets back to that issue of leadership and the NASDAQ. There's fewer and fewer strong stocks that are trying to lead the way right now. Facebook seems to be the strongest stock on the NASDAQ. And so we'll see what happens as it moves higher. Positives are, of course, it appears we're, positives are, of course, there we go, that the TSI is down towards the lower reversal where it has reversed previously. Unfortunately, the momentum for the week so far, and we'll see if this ends up like this, is actually down a little bit. And so we'll see if, but we have this long-legged hammer last week, what appears to be a Dragonfly Doji this week, where we know where buyers have come in now. And to support this move, we'll see where the sellers really come in to take effect. Will it come in effect, take effect at the 8-week moving average, or will it be up here higher, about the up here in the 3660, 3650 level? The Russell. Okay, on the Russell, nice hammer from last week, still in effect, as it is in all the reversal signal for the week last week on all the indices are still in effect, and they're moving up towards the lower portion of the fib box, and then this fib box here is the 38.2, 61.8, and it's from this high here to this low here. And so this is the 1/3 to 2/3 retracement where you would anticipate a reversal and or a stalling effect to start taking place. As we can see, we've got a little bit of work to do to get it up into those areas. And also, it's got pretty strong resistance there at the 1040 level. And so we'll see if it jumps up here or not. Right now, similar story to the if the weakness is going to continue. Similar story to what we had going with the each one of the indexes is that zero line on the TSI. If the index is going to remain weak, we may push up close to that, stall, and then turn back around, and we would anticipate price actions to turn at that point also. So, Mike, with what you're seeing on these charts, I'm going to call up Michael. I'm going to call up a couple of things. You were saying TLT.
Yeah, TLT is a nice. I think that's really the most interesting one.
Okay. Now TLT.
When did we have the interest raise?
It was in later part of, I want to say about here, and no, mid part of about the 16th of December. So about here.
Okay. Because there was a lot of turbulences.
Yes.
The volatility all the year was very low, and then there was spike, and then volatility went down, and we had basically the crash of January, and there it went up. So basically, all these trend lines have been passed.
Yep.
And now it seems to have. So I would have thought that now it has strong resistance.
Yes.
So I am surprised that today it's up again.
Huh. Okay.
Or maybe it's really the last. How do you say the last?
The last hurrah.
Yeah, exactly.
And then the other one, of course, I also watched the VIX. VIX was doing some very interesting things, and we'll take a look at the tradable part of the VIX. But it had jumped up here 2 weeks ago. It started penetrating this 30 level, and as we can see, looking back, going back to even 2011, it had made a couple of flurries up in past the 30 level, but they didn't last too long. This was the 2011 time frame. That was the bottom. Here was the August 2015, where the market kind of went and did that flash crash thing. That was a bottom. And we'll see if, was this period on 118, was that a short-term bottom that was put in? It appears like it might have been, but also, let's go over here to the VXX. Now the VXX is the ETF for the VIX, and you can actually trade this. It has some exceptionally wild moods, swings, and so you have to be very careful with it. But it too is starting to fall. It's got a fairly good opportunities. But as it's reverting back to the mean, as we see it doing here, the market is in fact going up. But you have to take a look at this. This is an interesting trading entity in that the move from here up to here was about 45%, which is, well, it's an interesting trading entity, but it is very, very volatile. And so a couple of other, I want to take a real quick look at a couple of stocks before we move on. One, Facebook. Facebook did exceptionally well with its earnings and guided much higher, and we see what happens with Facebook. It was giving us nothing down here that would say buy me before earnings, and you get the big gap up, and so now that we have a gap up and it has broken above its past highs at 110, now we're going to be looking for some kind of a pullback or waiting for the moving average to catch back up with it. But Facebook looks like a stock that is going to continue to run. And then on the other side of that is Netflix. This is part of the FANG, which is Facebook, Amazon, Netflix, and Google. So as you can see, after earnings, Netflix had earnings this week. They tried to rally, but this is already in a downtrend, and so they have not bad earnings, but it just has continued to fall since earnings. And Netflix is one of those, and I'm looking at for a potential short candidate. Amazon. Amazon was so interesting. How many watched Amazon yesterday? As it made this huge $50.
I did, yeah. After close.
Yeah, $40 move. And this is one of the reasons why I tend to stay away from stocks the day, shortly before earnings, or I'll be out of the trade before earnings, because they disappointed last night and came in short on revenue, short on profit, and gets hammered today, way down here. And on a weekly chart, on a intraday chart, it was actually painting down here in the 550 level, which was this past support, but it didn't open up here. But that's how far it had dropped. Now, what will Google do?
I mean, these earnings sessions has been thrilling.
Yeah, thrilling. That's the word.
Microsoft, I mean, Facebook, I just read a technical analysis on Facebook. I think basically that's a century event that a major stock makes, I think it was a 3 standard deviation jump.
Yeah,
like that.
yeah. And there was a huge amount of buying volume. As we can see, Google is posturing, getting ready for earnings, but earnings are Monday after market close. And then another stock that was kind of interesting, it is definitely a growth stock, but some of you may have been, we've been following this one on the IBD 50 list, and it had been a leader, but look how it fell out of bed. I mean, it actually had a bigger loss than, I think bigger than Amazon, but it drops down here. But the earnings report wasn't really that bad, and so you get a rebound after earnings, and now it's kind of fluctuating here, and so now we've got a really defined good level of resistance for potential short trades that would go from here down. As we say again, but interesting how at the same time this huge amount of buyers that came in to prop up the price of this stock is quite impressive. So this could do a couple of things. One, it could just continue to fall out of the sky, or it makes the buyer say, hey, wait a second, the earnings weren't really bad, and it was fairly good guidance. And this is the kind of stock that occasionally you see it turn and just start moving back up and to the right. So now something to at least keep your eye on for either a potential short, or see if it does something constructive here that can move it back into a more positive posture. So, okay. So, are you sure it's time to get long? Michael sent me this awesome cartoon. And so, Michael, I'm going to throw that question to you. I love this. Here's a bear. Here's a bear. Here's a bull. And, are we in the process of looking at a bull trap? So is it time to get long, Mike?
Yeah, I mean, statistically, it's always a 50-50 chance. So it depends on the duration, but I'd say, and the traders I know, or the guys who play a little bit also with short-term movements, I think are basically two. They were surprised that after the big, you could almost say crash in the first 2 weeks, that resistance was so weak. I mean, that was surprising, and I'm also surprised that let me. Where's the chart there? I have my own chart, so maybe you can just. Yeah, I mean, it took 1, 2, 3, 4, 5 trading days without any strong rebound, and that's also pretty exceptional.
Yeah.
So today's rally, I think it's overdue, and I wouldn't interpret anything in that. It's really just a technical thing that was overdue.
So in other words,
and that's the first thing. And the second thing is that I hear traders saying, or desperately waiting for a strong rebound, not because they want to see the markets to turn, but just to add add capital to the short side. Or in other words, they were surprised that the end of December was so weak that they missed to put, they were on the right side, on the short side, but they were surprised that the downtrend came so early, and then they had not enough capital allocated to the short side.
and
they will do
yeah.
again when, as you said, maybe 197 is the next, or 1970 is maybe the next resistance. So bottom line, I would be careful. Very careful.
Yeah. Well, I think what you said, it basically is a high risk market. And if you read, some of the more quality, financial outlets like, like IBD, like Barron's, like, and I recognize that, it's always an opinion by the people who write the articles and all that kind of stuff, or the people who get behind a mic and talk. But, for those who are looking at the technical part of it, I think the technical analyst, as long as they are properly interpreting, are basically, if they're saying be careful right now, because the probability of having at least one more significant down leg, fits with the traditional technical, evaluation of where the markets are. With the Russell, we've had 2 down legs, and typically there's a little pull up, and then it does a third, and sometimes that third down leg is more violent than the others. So Michael, you're not, cash is a good place to be, right?
Definitely.
Okay.
Yeah, especially at the dollar. That's maybe just to mention that as a treasury, I think it's an interesting thing. And the other exceptional thing is now the Swiss franc. It's the first time since the debacking that it reached 110 to the euro.
Wow.
That's always the thing to watch. And there were rumors around. I mean, the Swiss National Bank is loaded with crap.
Can you define that for me, please?
Really, so that 110 maybe they try to unload a little bit.
Yeah.
But the stock market has been too weak, so and the economy is not doing that well. So that's so the insiders think that's not the case. So the other case, and that brings me to the dollar, is that and then the other exceptional thing is usually as soon as volatility is high, investors flee to the Swiss francs as a safe haven.
Yeah.
And so it went just the other way around. And so the interpretation is that a lot of carry trades are now going on, and this is maybe the big maybe the big trading vehicle at the moment. So that they short the Swiss franc, so or in other words, they land Swiss franc, and then they buy maybe Australian or
Australian what? Dollars? Michael. Somehow I lost Michael. So, and can you guys still hear me? If it just, yeah, the connection's been lost. Hello. Hello. Oh, come on now. Hello. 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 Okay.
Go on. I think we have a little technical problem.
Okay. Yeah, we're back.
I also couldn't hear you, but
okay,
I can hear you.
Yeah, no, you were talking about shorting the Swiss franc and then going long the Australian dollar or something like that as a bearish trade.
Yeah, maybe Canadian dollar, maybe.
So,
or maybe also US dollar.
Yeah.
Going long.
And because the U.S. dollar is certainly, that's one thing that it is holding up and continue to be strong. So where's the path of least resistance? I think on a short-term basis, that up to resistance is probably the path of least resistance, but longer term, I'm looking for a more downside risk. Now, the thing about when you have an opinion like that, you have to be very ready to change your opinion if the technical analysis shows and proves something else. And so what would it need to prove that we're going back into a stronger uptrend is we need to see a series of either, higher lows breaking through old swing highs, and the longer term moving averages, the 50s, the 100s, the 200s, starting to reverse course. And right now we're not seeing that course reversal. So we won't get married to an opinion, but at least for right now, these are the things that I'm seeing, and then I think Michael has confirmed with regarding it's a high risk market. So it's a good time to be careful. I mean, it's a good time to, if you are going to try to go long, go with a smaller position size, because the market is still in a technical downtrend. Okay, this is basically the closed positions we've had so far for the month, and we're sitting up about 1141. Here's our equity chart. The white line is a projection of a 40% return on $100,000. I think it's either $100,000 or $70,000. Yeah, $100,000 for the marginable account. And so that's what I'm tracking against. And January, we've ticked up, but that's the average that we're looking at, seeing how close we get to that. Next monthly BAM meeting is coming up in San Jose on the first Saturday in February. The early warning alerts have been posted. The back testing for downside trades using the active trend trading system and early warning alerts will be done, and the report was coming out by the end of the month. And then the getting started videos, I just recorded those and posted those online yesterday. And that's for people who are new members to the active trend trading and earlier warning alerts, to show you exactly where to go on the website to get a jump start on the training and that type of thing. Active trend trading system is basically follows the 5 pillars of trend trading. It tells us what to trade: top quality IBD growth stocks and index ETFs. When to enter, when to exit, what strategy to use, and what to expect. One of the things that I'm very pleased with about the active trend trading system is that it also has kept us out of the market when it's higher risk. In reality, we have been in cash ever since about the 3rd week in December. And so we did not suffer from any of the big downswing. We focus on 3 different strategies built on the system: stock and index ETFs. This is 70% of our trading capital go to this, 10% in the option area, and then wealth and income building and income 20%. And you can go to the website and see here's what is offered with the active trend trading, the early warning alerts. And so I know that one thing that I really enjoy doing is these weekly midweek market sanity check training sessions. Now we're doing them on Tuesday night at 6:30 and recording them. I've had so many positive comments back from members saying that that has really helped them become better traders. That I like being able to help folks do that. So if you're listening or watching this video, I'd like to invite you to take advantage of a 40% reduction in the regular membership, which is a monthly membership for $54.99 for $32.99, or the early warning alerts. And Mike and I are going to do a training session on that, recording on that next week. $3.99, a saving of more than 60%. And the website that you can find those at is right there at the bottom. So with that, Michael, thank you for joining me. I'm hearing a...
Welcome. What's the background?
Yeah, that background noise was my dive. When I hit certain levels, I have a audio alert that goes off, and the dive usually means things are going down or something is going down, whatever that trigger was on. So, like the old submarines. So I want to say, see you guys next week. Keep the A growing and trade wisely, trade profitably. Again, Michael, thanks for being here. Thanks to everybody who's been online. We can look at a few stocks if you guys want to. And with that, God bless. So I'm ready to look at some stocks. Okay, any stocks, anybody? Yeah, Michael, you got one?
Well, for education purposes, it could be good to show some bank stocks.
Sure.
These were pretty disappointing, like BAC or Wells Fargo. That's WFC.
Okay, hold on just a second. Somebody,
Then
Solomon.
I think technology has been pretty chaotic. I mean, Twitter, GoPro has been hammered, and oil is USO is maybe also a nice one, so that you get aware how big volatility here is.
Okay, hold on just a second. I'm going to do some of that.
Our old brand Umber, I think.
Okay, I've got somebody asked for Verizon.
Yeah.
And so I want to take a look at Verizon. As you can see, Verizon basically for the past 2 years, I mean, Verizon's a great company. I mean, they are my service provider for my mobile numbers. When I worked in the wireless industry as an engineer building towers for multiple carriers, Verizon was the one that has the strongest service, regardless of what the advertisements say. It's because of the technology that's behind the technology that's behind the frequency range that they broadcast at. It's just a stronger signal. Anyway, what we got for Verizon, nice bounce up, must have been earnings. It was pushed on higher. Will it stall out here at the 50 level? We don't know. Right here from here to here, excuse me, about a 13% move from, for the past year. Verizon has been in a, 27% range. It is, Verizon is not a growth stock. And while it is a great stock, it's a great company, you're not going to get the big moves that you would with other growth stocks. So, Michael, you got a BAC. Is that Bank America? It must be Bank America.
Yeah, I think this has been especially weak. Huh?
Oh, look at that. Yeah. Weekly chart on the left. Let's take a look at this on a.
You see how analysts can get it wrong. I mean, it was supposed that after the raise of rates, banks will go up.
Yeah, and guess what? Not happening. I mean, here basically it looks like, from a purely technical standpoint, we've just about on a monthly chart got the 8-month crossing below the 20-month. Those death crosses have already taken place up here. We're at a level of support where we could bounce back up, close the gap back up into the moving averages, but this looks like, hey, I've got a whole bunch more downside to go. And you got to remember, Bank America back in 2011 went from 14 down to $5. Will it make that round trip again? We shall see. And Wells Fargo, WFC. Wells Fargo was designated one of the strongest banks. Let's see what its chart says. Yep, you can tell from its chart. It is a stronger player than Bank America. It's been a much longer uptrend here, held on to its value, but it also is going through something very similar to what's been taking place with the rest of the banks. It pays what's its dividend? 37 cents, 38 cents on a 50-38.
It's not that good, huh?
Yeah, it's about $1.50.
Well, but that's not a yearly one. That's a quarterly.
It's about $1.50 on a $49 stock. So what is that? About a 7.5% return? 5.5? About 3% return. So, and what other one? Let's take a look real quick at oil to see if oil is Has oil found a bottom? That's a great question. Okay.
Wells Fargo, the yield is 3%.
Yeah. And so we've got here, oil came down, hit a new low, $27 a barrel. When was the last time it was down at 27? Okay, it was down there back in 2003. Let's see what happens. I mean, if it does drop down here into around the $20 range, I mean, I'm not a value investor, but it's hard to imagine oil staying down that low for very long. And when I say a value investor, I utilize I want a good solid fundamental stock and or entity, but I look at the technicals for when it's time to get in. Let's see, we've got Cray. Switch back over to the, there we go. Okay, good buying coming in, good buying action coming into Cray as it got ready for its earnings. So we get a nice good pre-earnings run. It's moving right back up into what is old resistance up here at the 40 to 41 level. What's it going to do? It has earnings coming up on 211 after the market has closed. And so, you know, I would need to do the stock checkup on this, Tracy, just to see what, what kind of fundamentals it has. But from a technical standpoint, somebody knows something because, they're coming in here, started buying it up back in October, and that's been a strong move ever since. And the way I would, again, I'd be looking for the, the pullbacks back to the 8-day moving average or the 8-week moving average. And right now, they are, it is way extended from everything. So, any other stocks, guys? A couple that are on my my watch list that look interesting, and I'll just throw these up really quick, is Annette. And I think, what's the name of this? Yeah, Arista Networks. What makes this interesting to me, I would need to, I think it has pretty good fundamentals. I ran the stock checkup on it. It looks okay. What interests me is it's holding this support level. And even if it stays within just this range, trading range here, which it could potentially do, from the low here back to the high here is about a 33% trading range. If I was trading, where would I have a stop? Well, Sandra, it would depend on where I got in at it, where I got into the stock at. So if I got in, to the stock here at 28 bucks or 30, 28 to $30, and from here up, right now it would be up 30. And so what I would be doing in a situation like that is I would put a trailing stop at about 12% below and adjust that on a daily basis, but 12% above whatever the high is today. And that would be my trailing stop going forward. Of course, if I had gotten in down there and was already up, 30%, it might be and I know it's into resistance. I would look very hard at taking some of the profits off the table. And if I waited for a pullback to the 8-day or 8-week moving average or the 8-day moving average, I would utilize a 4% stop loss from whatever price I got into the trade at. Okay. So Annette, back to net real quick. It hasn't really shown us a lot on a daily chart that it's ready to turn around yet, but it, like I said, it looks interesting, and it is very much, very close to a strong support level, and it does have earnings coming up on February 18th, and so it may be getting ready to go into a pre-earnings run. Another one that I like, Ellie, kind of a junky, crummy looking consolidation here. Looks much better on a weekly chart. And at this point, I'd be looking for any type of bounce back to the 8-week. But be aware, it does have earnings coming up on 2/11. Nike is another one that looks to be coming out of a base. It would be nice to get it up above the 50-day moving average, but Nike is, again, this would be looking forward towards it being an Olympics trade. And let's see what else we got. I think that's about it. So, and we're at the end of our time. So I want to thank everybody for joining us. Michael, have a great weekend. Everybody else have a great weekend. And we'll be chatting with you next Friday. Thanks a lot.